In class 12 business studies, we are on chapter number 9, that is second book, financial management. And in financial management, we are on the topic today, capital structure. See, in that chapter, the first part is related with the decisions or financial functions, and that part is related with financial decision and financial functions. So here today we are going to start the new topic or the second part, as the second part of this chapter contains financial planning. Yesterday we completed, and the day before yesterday you can see the prior videos that financial planning, objectives of financial planning, importance, meaning, types of financial planning that we complete. Now the topic is capital structure. See, the capital structure means the combination of debt and equity. Combination of borrowed fund and own fund. So in this topic you will see what will be the capital structure of the company and what are the factors affecting it. So first of all, note down please, this is the topic capital structure. Now what is the capital structure? Meaning of capital structure that I am going to explain. Is it visible? My voice is clear? Okay. What is capital structure? Capital structure refers to the mix or composition of long-term sources of funds such as equity shares, preference shares, debentures, long-term loans, reserves and surplus. So the combination or the mix, composition of own fund, borrowed fund, okay? Debt, equity. Debt means debentures and long-term loans, and equity means equity share capitals, retained earning, surplus, reserves, etc. So capital structure is the combination, mix, composition of sources of funds. Okay, note down please. This is the capital structure. Now, capital structure refers to the proportion of borrowed fund to owned fund. Just now I told you, borrowed fund means external sources. Owner's fund means own fund. So it is a mix. It is a combination, and it is the combination of owner's fund and borrowed fund. Owner's fund are known as equity. Just now I told you, equity means equity share capital, reserves and surplus, retained earning. Borrowed fund will be termed as debt. Debt means debentures and long-term loan, which is known as external source also. So it is the proportion, combination of debt and equity. You can see this diagram. This is a mix or composition, or we can say it is the proportion. It refers to the proportion. Then capital structure. Capital structure of a company consists any of the following. Only the equity shares. Depends on the company, my dear students. It depends on the company. Only equity share. Combination of equity shares and preference shares, combination of equity shares and debentures, equity, preference and debentures, equity, preference, debentures and long-term loans. It depends on the company. Company can choose any capital structure. See, if you want to start the business, it's your choice that you want to take a bank loan, you want to issue debentures, you want to issue equity shares. It is the policy of the company what capital structure they want to consist, they want to make. So it depends on the company. Generally, it is the policy of the company what they want. Now, financial leverage. See, in this topic, you will get very new terms, many new terms. Capital structure is the proportion, or capital structure consists any form of this. Maybe only equity share, maybe equity share and preference shares. Equity means own sources. Equity and debenture means own and borrowed. Debt and equity. Equity, preference and debentures. Generally, it depends on the choice of the company. But company now cannot issue preference shares. But in case they can issue debentures, because debentures are the consist features of preference shares. Also, in class 11, we explain you about that. We already discussed these sources of finance. Now, next term is, what is financial leverage? Financial leverage, note down from the screen. The proportion of debt in the capital structure is called financial leverage, capital gearing, and the main term which I want to tell you, that is trading on. This is the term for numerical of this chapter. What is financial leverage? Leverage means proportion of debt. Debt means debentures and long-term loans in the capital structure of the company. It is known as financial leverage, capital gearing, or trading on equity. Leverage in finance is proportion of debt in the total structure. See, just now I told you that capital structure of the company is the combination of two things: own fund plus borrowed fund. Own fund is also known as equity and borrowed fund is known as debt. So the proportion of debt in the capital structure is known as financial leverage. Means debt upon capital structure. Debt means debentures, long-term loans are the part of debt, long-term loans taken by the company. See, in the books, that topic is given in a very tough language. So I try to make it in easy language for you. Like this question will come by three terms. That first is financial leverage, maybe capital gearing, and the main term which I can tell you should learn, that is trading on equity. The term is equity, but the meaning is proportion of debt, debentures and long-term loans in the total capital structure. Note down please, because one marker question is there. When the proportion of owner's fund is very small, it is said to be high gear. High gear. And when borrowed fund is more, it is called low gear. This is the question trading on equity that will be included in numerical in this chapter, but that topic is given in a very complicated, tricky language and terminology is a little bit difficult for you. But according to me, you should learn by this way that the proportion of debt in the capital structure, simple language, debt upon capital structure is known as financial leverage. It is also known as capital gearing. It is also known as trading on equity. And see, my dear children, see language. If owner's fund is small, it is high gear, and when borrowed fund is more than equity, it is called low gear. Now, what is financial leverage? Just now I told you high geared and low geared. I will explain you it by numerical, and tomorrow we will start numerical. But first of all, the term which I told you you should learn, that is trading on equity. In for present year, that term is very important. Trading on equity. See, trading on equity. Note down the term trading on equity. Trading on equity. See, trading on equity refers to the use of fixed income securities. Fixed income securities means those securities which gives us fixed income. Fixed income in form of interest or dividend, but the amount is fixed. So that is possible only in debentures and PS capital. Because in equity share capital, the fixed income is not possible because they don't carry fixed rate of interest. Okay? Equity shareholders always get additional profits with the help of employing other funds. EPS means earning per share, and it is known as financial leverage or capital gearing. But in exam, you will get one numerical of trading on equity because that is given in various papers. Numerical is only one in the business studies, and that is related with trading on equity. And in tomorrow's video, I will explain you the numerical. So trading on equity means use of those securities which gives fixed interest or dividend income. Generally, debentures is the combination here because PS now the companies cannot issue. So debentures always carry fixed rate of interest, like 8% debentures means 8% is the rate of interest on it. Note down. Company always include these types of securities in their capital structure so that EPS, earning per share, can increase. See the line which is given. Equity shareholders get additional profits with the help of employing other funds by debt, by bank loan, by debentures. It is known as combination or financial leverage. Tomorrow we will do the numerical, but today is the topic factors affecting the choice of capital structure. What are the factors which affect the choice of capital structure? Will you choose debt or equity? First, as I told you, cash flow is the point that is the factor in all the decisions generally. Cash flow, note down the topic, factors affecting the choice of capital structure. Factors affecting the choice of capital structure. Note down the headings only because tomorrow when we will do the numerical, that time I will explain you these points. First, cash flow ability for servicing the debts. Cash flow ability for servicing the debt. If the company has a strong cash flow inflow, then they should choose debt to pay the interest regularly. Then next is note down the formula interest coverage ratio. EBIT, earning before interest and tax upon fixed interest charges. This formula you will get in accounts also. Interest coverage ratio is equals to EBIT upon interest. Higher the ratio means lower the risk for the company to pay off interest in time. Interest coverage ratio. Then debt service coverage ratio, DSCR. Debt service coverage ratio. Cash profits generated from the operations must be enough to pay the debts, to pay the services. The next point is ROI, return on investment. See, it is the simple term. ROI should be greater than interest for debt. Otherwise, that will not be beneficial. Return on investment should be more than the rate of interest of debt to be paid. If you are paying bank interest by the rate of 8%, then the ROI should be more than 8. Okay? ROI should be higher than rate of interest for debt. Then cost of debt. Cost of debt means firm is able to borrow at a lower rate. It may always prefer more debt. Means cost of debt is less, then companies should include debt in their capital structure. Tax rate. Tomorrow I'll tell you about these points. Don't worry, in the numerical tax rate, I will tell you how to the tax rate influence the capital structure. If tax rate is high, company will prefer more debt. Why? Because the interest on debt is deductible expenses. Company has power to deduct it in their income. That's why it is deductible expenses. That's why if the tax rate is high, company will prefer more debt than cost of equity. Equity means share capital, equity share capital, reserves and surplus. When a company increases debt in their capital, the financial risk faced by the equity shares may increase. Because the company has to pay interest to debt first, then remaining amount will be available to equity shareholders. That's why. So that the company cannot use debt beyond a point. A limit, up to a limit, a company can use debt. Then next, yesterday also I explained you what is flotation cost. You can see the previous videos. In financing decision, we learn all these points, but for capital structure that required again. Financing decision means the combination of debt and equity. Here also, flotation cost means the cost incurred for issuing the shares like brokerage, underwriter commission. The next point is risk consideration. See, when you issue the debentures or when you issue the shares, it always will be in the mind of the company or the finance manager that the risk consideration should be there. It must be considered while choosing a suitable capital structure. There are various types of risk in the business. Okay, but according to the financing point of view, there are two types of risk, that is financial risk and business risk. So first of all, before issuing, every company should see the risk factors. The next is flexibility. Flexibility means the company should see that they have power to change the condition or not. Means if they issue debt, they should redeem it, they should have power to convert it. See, before starting, I told you there are various types of debentures. Convertible, non-convertible, redeemable, irredeemable. Okay. So that should be flexible. Now the next last one, control. These points are similar in financial decision and investing decision and here also and even in dividend decision, that is control. If the company wants complete control, okay, debt financing is to be recommended for raising additional funds only. Otherwise, in case of that, the control will be in the hands of company because the debentures don't have power to attend the meetings, they don't interfere in the workings of the company. Then regulatory framework. Who is the regulatory authority for share market, for shares and for companies? SEBI, Securities and Exchange Board of India. They will also frame SEBI also frames some rules. Before capital structure, company should follow the rules by SEBI. The next, stock market condition. Yesterday in the previous videos we discussed it. There are two types of market. Boom means bullish. Recession means bearish. In booming situation, when that is bullish market, then share will be more preferable. Everyone is ready to invest in the share if the market is on boom. The next, capital structure of other companies. See, what are the capital structure other companies are using? The company will follow the competitors' policy also. If other companies are issuing shares, equity shares, the company will also try to issue shares. So generally competitive factors are there. These are the points we discussed. Factors affecting capital structure. What is the cash flow ability? If the company has fast cash flow, strong cash inflow, they are able to pay the interest on debt. Interest coverage ratio should be considered. Debt service coverage ratio is there. So these are the points we discussed. If you have any doubt, you can ask. Today we discuss these things, that the capital structure. Capital structure is the combination of own fund and borrowed fund. Own fund is equity, borrowed fund is debt. Equity means equity shares, reserves, surplus, and debt means borrowed fund, debt, debentures or long-term loans.